Good evening, everyone. Welcome to this conversation tonight on the Mango Capital Spaces. For the next hour, we're going to be talking about the state of East Africa's largest economy at the moment. You see, every year the World Bank releases at least a report twice a year that's at the state of the Kenyan economy. And for the average layman, it might look like a dense and complicated document. But once you get past a couple of pages in there, it actually does make for very interesting reading and important reading, especially if you're a taxpayer in this part of the world. So here's what you might have heard, at least in coverage of this report. The Kenya Economic Update is the formal name for this report. When it came out about a week ago, the bank raised the growth outlook for 2025 from 4.5% to 4.9%. An improvement there. Kenya is still being assessed as being at high risk of debt distress. And our efforts at fiscal consolidation, so basically making sure that we can cover more of our spending from our taxes rather than from debt, that's being constrained by a combination of factors, weak revenue collection and high rigidity in how the Kenyan government actually is spending what it raises from you in taxes and in debt. But beyond that, there's always a lot more information that comes out in the report. So for example, the Kenyan government spent $9 billion, that's a better part of $1 trillion, supporting SOEs like Kenya Railways, Kenya Airways, and so on and so forth in the year to June 2024. The comparison, that's 1.3 times more than what was spent on foreign and domestic interest service in that period. Is that a sensible way of spending your taxes? We'll explore that in the course of the hour with my panelists. We have Hoy Tudela, who is a country economist covering Kenya at the World Bank. We also have Ryan Kuo, who is an economist in the Finance, Competitiveness, and Innovation Global Practice. It's a section of the bank that deals with matters around competitiveness as well. Also with us, I believe, in the space, we've got a representative from CAK. We'll see if we can get their input on that particular report that they co-authored with the bank in this edition, the November edition of the Kenya Economic Update. We have put in links to those two documents in response to the tweet on this particular space. So that gives you a reference point for all the stuff we're going to be talking about. Very quickly, though, I want to start with introductions. Jorge and Ryan, let's start with who you are. What do you do at the World Bank? Give us the brief introductions.
Thank you very much, Raman. Thanks to Mango Capital for the invitation. It's a pleasure to be here. Good evening to all listeners. Again, my name is Jorge Tudela, and Raman said I'm currently covering Kenya as the country economist for the World Bank. I'm based in Nairobi.
That's right.
Hi, good evening. Thank you, Rama. Thank you, Mango Capital, for having us. It's a pleasure to be here. My name is Ryan Kuo, and I am an economist with the World Bank. And as Rama mentioned, with our finance, competitiveness, and investment global practice, which is just a very long-winded way of saying that I focus on private sector development issues. Thank you very much.
But I want to start with you, Jorge. Give us the big picture here, because I've covered the growth issue and I've covered the argument that you made with respect to the spending rigidity that's holding back fiscal consolidation efforts. But from your perspective, what are the key messages in the Economic Update report for November?
Broad key takeaways, and this is the macroeconomic developments and outlook section of the Kenya Economic Update. First of all, the 7 key macroeconomic indicators in Kenya continue to show strength, and economic growth in 2025 is gaining momentum. As we explored in the report, inflation, for example, is within the Central Bank of Kenya's target. I think by November is 4.5%. International reserves are at a record high, around $12 billion. And credit to the private sector is also recovering. So economic growth, at least for the first half of 2025, that is the latest period we have data, has been stronger than in 2024. And this is across most sectors, especially agriculture and some of the industrial sectors, particularly construction. Second, and something that you have already pointed out, is that macroeconomic pressures remain. Maybe the second message of the Kenya Economic Update, especially fiscal policy, continues to, let's say, underperform with respect to its target. Last fiscal year deficit was 5.9% of GDP, above the original target of 4.3%, and this was supplementary one. And it was mostly driven by revenue shortfalls, which have been persistent over time. And of course, it leads to public debt continue to rise. We're already seeing in Q1 of 25-26, the deficit is again underperforming against its target, and now by around 0.2 percentage points of GDP. This is message number 2. Message number 3 is that because of this improved growth outlook, and growth progress for 2025, we have revised, as you mentioned, our growth estimates for this year. As you said, before it was 4.5%. Now we estimate it at around 4.9% for 2025. And what drives this update is that Q2 of this year was a surprise for us, was an upward surprise, especially the faster than expected recovery of the construction sector. And number 4, and this is what leads to our special focus and report on competition in this case, is that structural reforms continue to be critical to boost growth, especially on the medium term, as we have maintained our growth outlook for 26, 27, and they're important to unlock productivity growth and more and better jobs.
Ryan, I want you to give us a summary, if you will, of the focus of the report on competition, because one of the things that stood out for me, if I can essentially summarize it, is at one point you argue that according to the OECD and the World Bank's product market regulation database, Kenya has an overall PMR score 2.92. So that's the highest score of any country with available PMR data and well above the average for other middle income countries. And in addition to that, the high and growing gross operating surplus ratios, there's a lot of weak competition in the economy that's allowing companies to earn rent at the expense of workers and consumers. Tell us more about that.
Let me first start by saying that to a certain extent, I think Kenya's relative ranking is a product of the harsh curve on which it's being graded in terms of the countries with available data, which is predominantly advanced high-income economies, although there are some middle-income economies such as China and Morocco in there as well. But I think the overall message, as you rightly point out, is still that the data suggests that there is a lot of headroom to improve competition within Kenya. And that if this competition can be improved, then we estimate that there is the potential to basically drive the equivalent of 400,000 new jobs per year within Kenya. And if we think about what is the underlying driver of the state of competition within Kenya, this is obviously a multifaceted issue, but the report really zooms in on what we call government interventions in the market. That is, laws and regulations that themselves constrain competition, or direct government participation, for example, through state-owned enterprises that impact competition. And what we argue in the report is that there are select reforms to these laws, regulations, and how SOEs govern that we believe can really unlock that potential within Kenya.
And we'll get to those in the course of the hour. Jorge, I want to come back to you. With respect to growth, I know you mentioned the surprise that you got with the data from Q2, especially from contraction. But in addition to that, we've seen private sector credit growth has recovered over the course of the year. In January, it was in contractionary territory, contracting by around 3%. We're seeing 5% growth by September. PMI reading in October was at 50, stabilizing after months of contraction. But are we in a situation where the economy is just normalizing after a tightening cycle, or is this pointing to a more sustained growth trend?
So you can see this in different ways. First, I wouldn't use the word normalize. It always depends on where we are on the economic cycle. It constantly changes. So the private sector credit has turned positive. And as you mentioned, that the PMI score has crawled back over 50 is of course a sign that last year's monetary policy tightening is, let's say, unwinding. Okay, let's remember that monetary policy rate, a policy instrument from the Central Bank of Kenya, came down from level of around 13%, if I recall correctly, in August 2024 to now 9.25%. And this, of course, translates into lower lending rates and then into the recovery of private sector credit. Now, the improvement is so far positive, more in an environment of, let's say, lower inflation. It is still not yet at levels we've seen before. 2 years ago, for example, if we just speak about the nominal private sector credit growth, it was around 13% on a monthly basis, year to year. What is now evident is that liquidity conditions and financial conditions have improved, and that we are hopeful really that this trend continues.
With respect to the tax revenues, because I know you deal with this at some point in the report, and you're pointing out that Kenya's missed its revenue targets by an average of around 6% over the last 3 consecutive fiscal years. Is the main problem here that the design and implementation of the tax policy and the tax target is simply unrealistic to start with?
That's a great question, Rama. And many things can be true at the same time. Now, as you pointed out, revenue shortfalls, they can actually reflect a mix of fiscal or of structural, of institutional weaknesses rather than just a single cause. Now, it's the interaction of several challenges in enforcement, challenges in tax policy design, the challenges of informality, the challenges of budgeting practices too. All of them can contribute to fiscal performance. And not to extend too much on this, but probably you've also read in May 2025, we published what is called the Kenyan Public Finance Review. Now we cited in the KU, where we explore deeply this issue. And for our listeners, this far, it's a report that is usually published every 4 to 5 years in every country the World Bank works on. In Kenya, the last one before this one was in 2020, and now we updated. Perhaps we can have a longer conversation on Kenya's public finances, but what we do see is that, for example, structural causes, the growing levels of informality, are a key concern for fiscal performance, especially on the income taxes side. Income taxes are personal income taxes and corporate income taxes. We see that with the consistent fall of income taxes as a share of GDP, let's say in the last 10 years, is directly related to structural issues in CIT and PIT. For example, we see declining wages. But we also mentioned this in the report. Of course, they will contribute less and less to overall tax revenue. Same for the profit of companies. There are also tax administration challenges. For example, the registration. There are also tax design challenges. We speak about them in the report. Let's say there are numerous tax exemptions, both in CIT and in VAT. So all of this just suggests that Kenya has opportunities with regards to fiscal policy in all of these aspects, and that can support, let's say, a more progressive and a more growth-friendly fiscal consolidation.
And just in case our listeners would like to get a read of that, the Public Finance Review back in May 2025 that Jorge is talking about, I'll just put a link to it on Twitter under this particular space. One follow-up question to you on that particular question, Jorge, because you've touched on this briefly, but given sort of structural changes in the nature of the Kenyan economy, we're creating a lot more informal jobs and a lot less formal sector jobs that are more visible from a policy perspective, that are much, much easier to tax. And for context, for example, in 2013, the private sector created 106,200 new jobs. Last year, the figure was 45,100, so it's trending downwards. Given that sort of structural problem, doesn't that make our ability to generate a lot more tax problematic? Because we keep seeing these elevated tax targets. I believe the one for this fiscal year is 2.9 trillion shillings, but yet we are creating a lot more informal jobs. So there has to be a recalibration there.
You're right. Again, beyond fiscal policy, the real question is whether economic growth is translating into more and better jobs and into rising incomes. And we have seen in the last 10 years, at least, the growth in employment, I think it was around 3.9% per year, but the growth in formal employment, which is characterized with, let's say, higher wages, was less than 1%. And the growth in average wages was actually, per word, no real term. There was actually no growth. The real wages actually fell by around 10% or a bit above 10% in total in the last 10 years. So, of course, it's difficult to tax falling wages and an economy that is becoming more and more informal. But there are avenues to raise more tax revenue in the Kenyan economy without necessarily raising taxes, for example. And this is something we also explore in the Kenyan Public Finance Review. There's a need to, for example, expand the base and combine fiscal policy with structural policies that promote growth in the economy and growth in better paying jobs that can actually contribute more to revenues overall.
One last question for you before I turn to Ryan, and then we'll bring in the competition authority. How should our listeners try and reconcile the fact that this is an economy that year in, year out, they hear that, the economy grew 5% on average over the last decade or thereabouts. But that same economy that's growing at 5% a year is creating fewer and fewer formal sector jobs. And they may not look necessarily at the data, but they probably see it right in their circles. They will find it harder to find a job or to switch jobs, or someone they know, their child, their niece, their nephew, might find it harder to find a well-paying job in the formal sector. How should we reconcile these two factors?
Can you repeat the two factors? Sorry, Raman.
Yeah. So it's two things, right? We've got a decade, more or less consistent annual growth, GDP growth of 5% year in, year out. But at the same time, this economy is creating fewer and fewer formal sector jobs. The assumption for a lot of people who'll be listening would be, hang on a minute, if there's growth, surely that should translate into more formal sector jobs, not less. How do we explain what's happening in the Kenyan economy? Why isn't that growth that we're seeing translating into better job creation?
Precisely. So this can be a very deep conversation about the structural constraints that the Kenyan economy might be facing. Now, it might be facing, we speak about the fiscal constraints that also create distortions for economic growth and formal job creation. There are other types of constraints, like in the external sector, for example, and the competitiveness of the economy. We've seen in the last at least 15 years that, let's say, the share of exports in GDP has been falling consistently over time. And this can be a measure of competitiveness for the economy. The Kenyan economy, it seems, from these indicators, that it has been losing competitiveness over time. There are aspects, for example, that we actually explore in the KU. And this is a good leeway to the next topic, which is competition policy. But we find there are many opportunities there where the Kenyan economy and policy can improve, and with that create more formal jobs.
Ryan, I want to get back to that PMR question, because on one hand, you said we're making a comparison to relatively advanced economies here, but looking at Kenya specifically, what are the main constraints to productivity, innovation, and price competitiveness as you saw it in the study?
I think it's a multifaceted issue, and a lot of these issues are interlocking. But maybe I'll just highlight a couple that conceptually really jumped out to us as we were doing the analysis. I think on a cross-cutting level, if you think about the number and degree of state-owned enterprises within Kenya and the degree to which they receive state support, this was quite high within Kenya relative to other countries that we've studied, including countries within the region. And so I think that was one area that really stuck out to us. I think the other area on a cross-cutting level that really sticks out is barriers to international trade and investment, which conceptually one can think of as protections against competition from foreign investors and firms. And here we can see that Kenya has very high both tariff barriers. So for example, I think Kenya's average applied tariff is around 14%, which is very high compared to other countries, as well as non-tariff barriers, such as, for example, quotas on duty-free imports from COMESA for selected goods. And in addition, on the investment side, a lot of what we call foreign ownership equity restrictions, which effectively are limits on the shareholding percentage that foreign investors can have. So taken together, if you look at these cross-cutting issues, what this means is that you have a lot of insulation from competition from foreign firms and investors, as well as this very significant subset of firms within Kenya that often receive advantages by virtue of their relationship with the state rather than their underlying productivity, and that in the long run drives productivity and has a chilling effect on competition economy-wide. I think the other area to highlight would be these legal and regulatory restrictions to competition at the sectoral level. And so I think if you look across sectors, Kenya has various sectoral laws that might, for example, make entry more difficult, or it might make certain forms of competition not allowed. So you can think of things like price controls or catchment areas that mean that only one buyer can exist in a given geographic area. And so if you think about some of these sectoral areas, I think it's very important to look at the sectoral restrictions in key sectors that then feed into the rest of the economy. Two, that the report really highlights, because they're such important inputs into the Kenyan economy, are in the electricity and fertilizer sectors, where effectively you have large state-owned enterprises that have received various advantages that then have depressed overall productivity and other market outcomes within those key sectors. And that, of course, then has knock-on effects for the rest of the economy. So just to give the example of electricity, historically speaking, a lot of the power purchase agreements that Kenya Power has signed with generation companies were not on a competitive basis. And that contributed to then those power purchase agreements being at a very high cost, which then gets passed on through Kenya Power to customers. Now, the government of Kenya, I think, does recognize that a lot of these are important reform opportunities. For example, going forward, it has put forward what it calls the Renewable Energy Auction Policy, which is a very encouraging step that will require these power purchase agreements to be made on a competitive basis going forward. And so basically, robust implementation of things like this are going to be very important to increase competition and ultimately bring down prices within Kenya.
And I understand that we're now being joined on the panel by Dr. Adana Wario, who's the Director of Policy and Research at the Competition Authority of Kenya. Dr. Wario, when this study was worked on, what is it that stood out to you and the team? What are the things that stood out for you among all the other issues that were covered? Pretty broad. It covered everything from infrastructure, railway, aviation markets. I know you looked at telcos, you looked at agriculture. What was the one thing that stood out for you?
I think one thing that stood out very well for me was the state-owned enterprises in Kenya across the different sectors of the economy, and the opportunity that we can take now based on this recommendation, because the report basically is a looking forward report. And therefore, there's need for us to see, given this report, what are the priority areas from competition perspective that we can take moving forward in more prioritized manner, and also looking at what are the potential impact of those reforms to the Kenyan consumer. That's what stood out for us, but also the nature of the pattern in different sectors with regard to a state-owned enterprise, I think came on very clear.
With respect to SOEs, what tools do you have to rein in anti-competitive behavior? Because looking at the sort of numbers that came out in this report, if the state is willing to burn the part of $1 trillion, right, on supporting SOEs, that's an enormous amount of cash that private sector players simply cannot hope to get access to, especially at that sort of pricing. So what tools would you have at CAK to intervene, especially in a situation where the state is effectively playing on both sides of the fence, because it's both rule maker, rule enforcer, and at the same time, it has a stake in some of these firms, like sugar companies, for example?
That's a very good question in terms of what tools or opportunities we have under this recommendation of the report. I think we need to look back in terms of the rationale or justification for establishing these state-owned enterprises. At the time, and now I think also there is need for us to realize that the main reason was for us, or as a government, to provide public interest issues or counterpart interest issues that are of no importance to government and also affects wider population of Kenya. So that was the genesis under which this report or state-owned enterprises were created. And in the current state, I think we need to review that process in terms of what will need to happen, given that there are certain rationale and government had a specific intention of reforming certain sector and also having some sort of role in terms of how the sectors perform. So for us, I think as an authority, our main mandate is with regard to competition is looking at the conduct of parties in trade. And in this case, government is not in trade in that sense, and therefore does not entirely fall under our purview in terms of conduct of these agencies. However, in most cases, the competition issues that might arise, or even with regard to procurement of these state enterprises, is that we need to look at how these state agencies are procuring their services and goods from third party. And therefore, in terms of competition neutrality, we need to look at what are the patterns of these state agencies with third party, but not looking at their key role, because they have that reform agenda given to them by government for market to efficiently play its role or provide services to the Kenyan citizen. So from a competition perspective, what we need to focus on is the neutrality of our decision in terms of parties that these state-owned enterprises engage in terms of providing services. If those services actually acquired with the aim of providing value for money or funding that come from government reform agenda or even state proposals that have a key role in providing certain services to the citizens and population at large.
I'm sure we'll get back to questions around market dominance in just a moment. Ryan, I want to come back to something I believe you mentioned a bit earlier with respect to the competitiveness of Kenyan enterprises, because one of the things that we've seen is a scenario where we've got relatively strong demand, and that's picking up at a much faster pace. But the competitiveness of our exports in the region is somewhat limited. And in fact, it actually has been degrading over time. The central bank governor actually flagged this not too long ago. What explains that divergence?
That is a big question. Look, there are a lot of things that will affect year to year competitiveness, especially for a market like Kenya, where a lot of the exports are rooted within agriculture. So you have things like year to year fluctuations in rainfall and other climatic conditions. Nevertheless, I think if you look at the inputs that go into a lot of Kenyan exports, there are some common themes that emerge. So especially if you're talking about manufacturing, electricity prices definitely are a key barrier to how competitive Kenyan exports can be. I think there's been a lot of talk about AGOA and the future of the apparel and textiles industry within Kenya. And electricity prices in Kenya are multiples of what they are in certain other countries, such as Ethiopia. And if you think about a textile plant, for example, electricity is 40% of the unit costs. And so it's just very hard to be competitive if some of your input costs are high. And that goes back to then some of the issues in competition and competitiveness within the electricity sector, as well as other key input sectors of interest. I think the other, maybe longer run, harder to quantify precisely is the capacity of the underlying companies. And so when you have basically insulation from competition, whether that is in the form of trade protections or certain laws that, for example, fix prices of inputs or outputs, then what that does is it reduces incentives for companies to invest in their productivity, to invest in innovation and better quality for customers. And I think the long run net effect of that then is that the average productivity of domestic firms goes down because they're protected and they don't need to be globally competitive. And even if they can sell domestically because they have all of these protections, that compromises their ability to compete globally in the long run.
And just to mention that in KU number 29, so that's 3 KUs ago, we had our special focus on Kenya's trade performance and trade policy, which also touches upon these aspects of competition that Ryan is mentioning, both in the short and the longer term, but also goes beyond it. So I also invite you, our listeners, to take a look at it.
Brian, one of the reactions when this conversation came up and we were looking at the report, I know the instinctive reaction from some players was one of the key recommendations that you're making it is that, look, at some point, the transfers that are being made to SOEs, like Kenya Airways, Kenya Railways, and so on and so forth, at some point, those have to be a lot more, they've got to be phased out gradually. But at a time when we're seeing a much more muscular application of industrial policy, consider, for example, how Ethiopian Airlines operates. They've got a ton of state backing. The state will actively either guarantee or put capital behind the business. We're seeing the exact same thing with Gulf carriers, Emirates, Etihad, Qatar, right across the Gulf. At a time when it seems like industrial policy is back in vogue, how then can Kenyan firms compete in an environment where their competitors in an international market are getting backed up by taxpayer and state resources?
I'm not going to comment on the other countries, but I think, and there's no one size fits all solution here. I think the key is two things. So number one is being very clear-eyed about the trade-offs that state support to especially commercial state-owned enterprises entail. Balancing the fiscal cost as well as the, if you're talking about KQ, the potential impact that could come from freer entry into the Kenyan aviation market, balancing the fiscal benefits as well as the benefits in terms of fare or connectivity that could come from basically freer competition with some of the perhaps other objectives that the government of Kenya has for supporting its state-owned enterprises, be that in terms of employment generation or national interests on specific routes and so on and so forth. And I think it is about quantifying those impacts on both sides to the extent possible, and then making educated or more informed decision on where the right balance between these national interest and commercial interest objectives are. I think the other part of the equation when it comes to support for state-owned enterprises is the governance of that support to make it more efficient and make it more fit for purpose. And so if we think about global best practice, it's not to say that state-owned enterprises should never receive any support. So I think Director Aroba mentioned this earlier, where it could very well be that the government needs a state-owned enterprise to do something that isn't fundamentally profitable, but is in the national interest, and therefore needs to make some subsidies or some other support available to a state-owned enterprise. So if you think about Kenya Power, maybe rural electrification is a good example of this. The key here is to then effectively ring fence that kind of support and say, all right, we need all of these shillings that are going towards this public interest objective that isn't commercial to be spent only on those objectives and accounted for separately, rather than having the possibility that it leaks into the commercial side of the business and then distorts competition there for all of the reasons that you rightly covered. And so to that extent, the recently passed Government-Owned Enterprises Act is definitely a step in the right direction. And at least from the World Bank side, we are very eager to see what implementation of that is going to look like.
Dr. Orio, there's an interesting question here for you from Justice Motanya. And here's what he's saying. What happens when SOEs have failed to promote the public interest? What should be done there? And the example he's giving is of the National Oil Corporation. It's a perennial loss-making entity, he says. And if you think about the structure of the retail market, at least for fossil fuels and for gas, most of us across the country can essentially have that need met by privately owned entities. Think of Vivo, think of Total, which I think have about 30 to 40% of the market between them, and a whole host of other smaller players. So in a situation like this, when an SOE is not delivering its intended purpose, what should be done? Should we just wind it down?
I think this is a real question that I need a real answer. Yes, National Oil has been doing very well for some time. I think before the amendment or establishment of 2019 Energy and Petroleum Law, National Oil has been doing very well. And there are certain structural changes that took place in terms of what resources the National Oil was overseeing. And initially, as you recall, the government provided some of the outlets for National Oil, and therefore it also acquired a number of them or owned by other agencies that also branded by them. I think what we might need to think about is what happened to an institution like that was performing well before certain changes, and why are they now struggling to be in the market? Because the main concern for the sector is not actually management of resources, but volume of resources, because the margin is generally low, and therefore the margin they make is based on the volume. So this is also a unique sector, and also a lot of multiplier effect in terms of Kenyan economy and its operation. And therefore it's a very important segment. And if you look at justification, as I have mentioned earlier, as to why this was created, was for government to play a role or to some extent, not to leave the sector, given its importance, not entirely to the private sector, but have a small role in that market segment. And I think therefore there are certain structural changes that took place. And this is what we need to look at. How can we diagnose the problem and see what are the best way forward in structuring it? And I'm aware that there are certain changes within the provision of competition law, that there are certain exemptions that they can be provided. They can form partnership with other agencies so that they can get a supply of a downstream oil and therefore remain in the market. And I think the role of government, given such a very sensitive sector, is still important. And what we will do is just look at what are the causes and why is it struggling now, and yet at some time it was doing very well. So I think we need to look at what are the causes and therefore how can we review and make it more profitable, if not make it exit the market. And I think that's what the government is already working on, with certain approvals that are required, are already in place. I think we see from there what happens and how it can still play its role in the market, given the sensitivity and the importance of this segment to the Kenyan economy because of the multiplier effect of this sector across the national economy.
The study also covers the telecommunication sector in quite a bit of detail. And one of the critical priorities that was identified here was, among other things, the lack of regulatory clarity on infrastructure sharing, radio spectrum management, and then gaps in the assessment of market power and related remedies. Now, the last time that a study on market power, at least in the telco sector, was done was nearly a decade ago, back in 2016, the Analysis Mason report. And a lot has changed in that period of time. Is there another review of the market that TAK plans to do perhaps next year?
I fully agree with you, the importance of this sector, particularly when many of our services and also supply chain with regard to logistics depend on this sector for even mobile payments and all that. I think it's becoming more and more important. And the sector is also very dynamic in terms of what is happening, what are the new changes, what are the new products coming to the market. We do realize that there are concerns in general public without providing clear evidence as to why certain players have remained dominant. And I think we need to appreciate what factors have made some of these players dominant and look at issues around the role of effective competition, the number of players, and also the sort of innovation that they have undertaken to remain in that dominant position, comparing the study you referred to in terms of spectrum sharing or open access, as they call it in certain instances, and also promoting investment. I think there's no barrier to entry in that sector, as we have seen with the recent entry by Talik. And that's one of other players that have come in recently. But I think just reviewing what has been recommended in the previous study that you mentioned, and looking at what are some of the suggestions I've made and how far we move from those recommendations today, I think is one of the things that we can look at. Because there's a lot of information that exists in the sector, it might require in our context what is called screening, by just looking at what information exists out there at the moment, what are some of the new changes or products that have come to the market, and how is these companies adjusting to new realities of dynamic growth or ecosystem related to platforms and digital markets. We might do that, but we have not planned yet for next financial year activities. But it's one of the things that we can look at based on some of the indication that public might throw out to us and say, there's need for us to look at that and see what are some of the new areas that we might need to pick up in terms of competition and also relating to consumers. Because with more financial inclusion, there's a need for us to look at now how many sectors are reliant on this segment of the economy to make a living out of that. So I think that might be one of the areas we can easily pick up and see what are the issues, what are competition issues, what are some of the deterrent action that we might need to avoid as government to make the sector more vibrant and more competitive and provide quality service to the citizen.
Building on a question that I'm getting here from a journalist who covers a country based in the UK, Samir Savlani, she's asking what reforms are needed in the telecommunication sector. And I want to build on that by narrowing it down and asking, what is it that stops CAK now from issuing a finding that Safaricom is a dominant operator, at least based on the 2016 study? And if such a declaration was made, what remedial measures would it allow CAK to impose on Safaricom?
This is a very important question, and also we need to appreciate the fact that this is an issue that has been there in public domain for quite a while, and we are aware the expression by public in terms of dominance of this market player. I would like to just state that competition issues or general telecom sector is regulated mainly by two agencies. One is the Communication Authority of Kenya, looking at economic regulation, meaning that they look at licensing issues and see before a decision is made, what is the likely effect of certain decision or policy decision they make on the sector moving forward, that they can use that as an instrument for them to see licensing issues around what they do and which players are playing their role according to the requirement. Coming back to our role, which we refer to as mostly as an ex post, we look at mostly in all sectors of the economy, not economic regulation beforehand. We look at the players in the market. What is their conduct in that specific market? And that applies also to telecom sector. In general competition application, dominance is not seen as illegality or a challenge in any economy. What is relevant to us is abuse of dominance. What has this particular player done to ensure the market work in their favor, or given a certain competition effect in the market, they might not be doing very well according to what they see as making huge profit or abnormal profit for that matter. Looking at competition as a way of providing remedial measures for dominance, I think our main point is only coming in when we look at abuse of that dominance. And as you recall, in the Kenyan context, at one point, we did intervene in telephone operation in terms of their agents across the country. And we know that at that time, they had exclusive agreement with specific agents, yet they did not invest in those agents, but they were able to exclude other mobile network operators not to provide service from those agents where they had an exclusive agreement with. We did intervene because from our perspective, that was not permitted under the law for them to exclude others from that business. So in instances where we see there is exclusive conduct or abuse of dominance as it refers to this particular case, we can come in.
I'm Mugambi Mutegi. I'm from the Competition Authority of Kenya. I've been requested by the hosts to say a few things as Rama tries to reconnect. I think what this report for us as CAK talks about, I can just start by adding a bit to what my director, Dr. Adano, has said. One, he mentioned about the strategic importance of NOC, and there was a disclaimer from Ryan and also from Dr. that the genesis of this SOEs was always good intention. There are some policy changes here or there, or decisions that can affect how an SOE performs. Already you are seeing, and Ryan has acknowledged that there are some changes that government is undertaking in the SOE space, acknowledging some of these issues that the report has clearly found. However, I think these changes or these actions, with specific reference to NOC still retains that strategic importance. And that's why if you check the public domain, we, as CAK, issued or gave them an equity strategic partnership with Rubis. I think it was around 5 years, with some disclaimers that they can't share certain things. They can't perpetuate anti-competitive conduct just because we issued them with this exclusivity. That we just acknowledge that fact, and he also aligned with that in government. In terms of the questions that KQ, talking about KQ, yes, we still retain our advisory role. We advise the county governments, national governments on matters competition law, consumer protection, and we keep doing that. Perhaps it's not front-facing all the time, but we do it within the normal government channels. I think, again, with respect to the abuse of dominance debate of the telecommunication sector, the truth of the matter is what Rama had asked about what stops CAK. At the moment, our law and what Dr. Adano was explaining is that our law is export in nature. It's a competition law terminology for saying we wait for conduct, then we intervene. So in what the example is given is that declaration of dominance in our Competition Act Cap 504 doesn't exist. Declaring someone dominant, the figure I think from CA already do that in itself. But our law currently does not have clauses that say once you hit 50%, as you just say 50% of the market or 40% with market power, you are a dominant player. So that declaration of dominance is not there in our law. So as we wait for the conduct, we screen the market, and that's what Dr. Adano was alluding to, that once we go to the market, maybe perhaps screen, then we can intervene. Before we test the Rama, he's come back online. I think I can give some general comment about competition law and its role in economic growth. I think this report clearly shows that in a limited fiscal space, what Kenya is experiencing right now, where taxes are not necessarily extra, or new taxes or higher taxes are not necessarily an acceptable or timely fiscal tool to use to reboot the economy, or taking on extra loans, you're already debt heavy. So competition law is being seen as one of the tools, non-fiscal tools, that can be used to reboot the economy. As I was saying, we'll increase DIs to the country, you boost innovation, efficiency in productivity without new public spending, you limit subsidies to some extent. When you curb rent seeking and monopoly power, again, there's more productivity, people, whether they're local investors or international investors, will come. And the numbers is what World Bank and Ryan had mentioned: 400,000 jobs, I think 1.15 percentage points growth in GDP per year. So competition law sometimes is seen as this very aloof economic concept, but clearly what the report shows, and if you study it well and slowly without necessarily looking at, as Ryan said, these are the silver bullet reports saying that what is here is perfect a solution for Kenya's current economic positioning. But competition law enforcement can be used as a non-fiscal tool to help promote growth in the economy, create jobs, and attract FDI, and also just boost the local investments in various sectors of the economy.
Jorge, I want to get back to you. There's a question that came up from our audience a little earlier, which I didn't get to. We're in the middle of a conversation around regulating the market and figuring out what the impact of competition regulation is like at the moment. Makulo is essentially asking, what are the trade-offs that come along with this, shall we say, supernatural stability in the dollar-shilling rate? Because if you plot the dollar-shilling rate, the euro-shilling rate, the sterling-shilling rate, those are the two crosses are moving quite a bit. The dollar-shilling rate is pretty much flat compared to that. So from their perspective, I guess the question is, what are the trade-offs from having a currency that is that stable? And what does that then do to ability to raise debt, our competitiveness as an economy, and our ability to attract FDI?
In the particular case of Kenya, we're yet to study this at its fullest. What I can say now is that, according to the government, the stability is mostly underpinned by improved macroeconomic fundamentals. And this includes, for example, improvements in foreign exchange inflow, driven by remittances, driven by export performance, driven by tourism, and of course, the foreign exchange reserve. Indeed, against other major currencies, not against the dollar, the shilling has depreciated a bit, let's say against the euro or the sterling pound. What I can comment is that in general, in economics, that there are, as the question rightly puts, there is trade-offs, there are pros and cons of an overly stable currency. Now, this is something that is well studied in the economic literature. For example, a stable currency brings predictability for businesses and investors. Firms can plan their imports, their exports, their pricing and investment decisions. Now, with less exchange rate uncertainty. Also, for example, there is lower imported inflation. Also, it supports the monetary policy transmission mechanism. So in this case, CBK can adjust interest rates without, let's say, exchange rate volatility. There are also, let's say, risks on overly stable currency in general. As you mentioned, there could be a loss of competitiveness in the case that inflation in the country, let's say, the exporting country is higher than in trading part. That is a real appreciation. Now, and this could hurt exports and make them less competitive. Also, it might lead to a build-up of external pressures. Overall stability of a currency can delay needed adjustments for it and lead to corrections later. And it also might affect buffers against external shocks. The comment rightly mentions there are trade-offs in having overly stable currency, but of course need to be managed adequately. In the case of Kenya, in particular, we have yet to fully study the currency here.
I'm going to put this question to both you, Jorge, and to Ryan. And this is from one of our listeners, Brian Kashisha, who's basically saying that, that the macro figures have been quite stable for the last 18 months, but there's a general feeling that the micro side of things has been grossly underperforming. And I guess for many of our listeners, we see it every day when you go to the supermarket and we think 10,000 shillings used to get me a certain amount of goods, and now it's getting me a much smaller basket. So we can see our decline in purchasing power that way. He's asking, what are the 1, 2, 3 things that the government can do, at least in the short run, to raise your income levels at that micro level? And you've covered, I know, part of this, Jorge, in your initial response, where you mentioned the central bank now has a bit of room to cut the policy rate without the FX rate taking a dive. But what else can be done to make the economic prospects at the household level, at the consumer level, so much better?
Oh, so this is rightly put, and in any case, before I was speaking just generally about exchange rates, pros and cons of the stability. But in this case, I think it speaks about the relationship between inflation, between wages, between purchasing power and living standards. Now, so inflation today, let's say, and inflation we have seen has been decreasing at least from rate that we had 2 years ago. Inflation today, low inflation reflects stability No? However, it might not reflect that affordability. This is something that we are seeing across the world, not only in Kenya. What it means is that the rate of change of prices has decreased, but not necessarily prices have come down. And when this translates to wages, let's say, it also means that prices have been rising faster, let's say, than wages. Now, and real wages fall because income growth, in this case, didn't keep up with the rising prices. Of course, this translates into lower purchasing power. In other words, leading with some moderate inflation. If wages don't rise, it reduces purchasing power over time. And this speaks again to what we were discussing before about labor market dynamics. Now, if formal job creation is weak, more jobs are created in the informal sector. And also something that Ryan mentioned is productivity. Growth is also low. All of this will translate into lower wage. The key message here is that in macroeconomic stability, there's a need to translate into improved living standards. Now, and going to the last part of your question, we can speak of reforms. It's difficult to pick, as we said before, like one or even just two reforms. I would say in the short term, it's key first to reduce fiscal vulnerabilities, but it's also promoting productivity growth. For example, it's a competition policy that I think the discussion of us today, and also implementing strong governance policy. That is also what we mentioned in the KU and in the PFR. And all of this will support now to seeing this translating increasing purchasing power in increasing real incomes for more Kenyans.
Very quickly, Jorge, before we get into the closing segment, to what extent can a recalibration of our fiscal policy, especially simplifying the tax code, simplifying implementation of that tax code and compliance, and lowering the marginal rates of tax, because that's something that the government has spoken about back in 2023 with a medium-term revenue strategy. To what extent can those proposals help to jumpstart that productivity spike that this economy desperately needs?
Definitely, there's a need to, let's say, at the same time that promoting fiscal consolidation and the reduction of fiscal vulnerability, there is also a need to promote competitiveness in the economy. And both, let's say, for firms, for companies, to be able to generate higher profit, but also to create more jobs. So what we actually, when going to the specifics of the policies, but what we actually believe is that it's actually a combination of fiscal, of structural, of governance measures that will help Kenya go through these fiscal challenges ahead. It's not just one against silver bullets. There are definitely different types of policies on all of these themes that need to be implemented to promote a more sustainable and inclusive growth.
I do want to bring this to a close, but I'm going to give Ryan and Dr. Rio an opportunity to give us a closing thoughts on this. Starting with you, Ryan, if there's one specific reform based on the many that were embedded into the report that you think could be quickly, easily implemented and deliver outsized returns, what would it be? Where should policymakers be thinking about focusing their attention?
So I want to stress that competition doesn't always yield benefits overnight, especially when you're talking about productivity, because then investments and improvements in practices take time to materialize. Nevertheless, I think there are two areas where I think there are perhaps short-term impacts to be realized. Firstly, I think is on electricity, where for select firms, something like open access regulations would, so for select manufacturers, maybe that can immediately lower their electricity prices if they're able to find a generator and enter into this win-win type of contract that open access would give them. And I think the second area potentially is on fertilizer, where if the fertilizer subsidy program, which we didn't talk about in depth today, but is talked about quite extensively within the report, is tweaked to better involve private sector competition in its rollout, I think those are two things where you have these critical input sectors where these reforms could lead to short-run impact.
Dr. Barrio, your closing thoughts as we bring the space to a close?
Thank you very much. In my view, I think we need to focus on those sectors that have multiplied on the economy from a competition perspective. And in my opinion, I think the sector that will have wider impact on the economy will be improving competition issues in agricultural sector, where we are looking at value addition in that sector more strongly, and therefore ensure that there is competitive outcome of those reforms that we undertake. And two, I think the energy sector also remain very important from our perspective. And given the importance of energy to all the sectors of the national economy, as well as how competition can promote employment in different sectors of the economy, I think we need to be tied to reforms within different sectors of our economy that are value addition, promote agricultural growth, and therefore create more employment as we add more values to the economy. And also there generate more growth impact outcome that will support our economy more broadly. So I think in terms of competition, we need to continue ensuring that competition basically enables our activities in the economy, and there is no barrier to entry, and government reforms are also in line with observing that the public interest consideration outweigh competition benefits in terms of the outcome that we envision to see. So those two needs to be compared. Public interest with regard to different sectors, those benefits have to outweigh competition outcome from our perspective. Therefore, we are good to go to grow our economy, get more employment, attract more foreign direct investment as well. Thank you.
And just to build on those comments, worth reading the full reports. We've certainly put links to them in response to the Mwango Capital timeline and the World Bank timeline as well. You should be able to see links to them over there. My thanks to all of you, of course, who've given us very generously your time. We certainly don't take it for granted. And of course, to my panelists as well, Jorge Tudela, the country economist here at the World Bank, and Ryan Cohen, economist at the World Bank in the Finance, Competitiveness and Innovation Global Practice, and Dr. Dano Ario from the Competition Authority of Kenya, and of course, Mugambi Mutegi as well. Thank you very much for your time and attention. We'll see you sometime in the future on Mwango Capital.